that they decided to loan this out was actually in commercial trucking industry. And the problem is that a lot of these commercial trucking firms defaulted in their loans. And that makes sense because of what's happening macroeconomically with inflation and high interest rates. Maybe these commercial banking firms were losing money already and they couldn't afford enough cash in order to keep paying up the loans that they had from this bank. And so a lot of the loans that the bank was giving out to these industries were defaulting, and that made the bank to lose money, right? And so when you're not earning as much and people are defaulting from your loans, you're going to have to, suck up your expenses. And so that's what happens. And even though that this bank isn't huge, right? This bank had a market cap of about 11 billion. So it wasn't the length of, let's say, like First Republic Bank, right? Or let's say US Bank Corp, right? This bank wasn't so big. But, it's a pretty big bank. It's a pretty big bank for a regional bank. And so this is what you should have avoided. If you just read the SEC filings, you could have saw what they were doing with their loans. To be honest, I actually haven't heard of this bank until a few minutes ago. And when I saw it, I knew it was alarming, and it ended up almost going bankrupt. And this is what's going to negatively impact the stock. The thing about a bank, so you can learn, the very important thing when you're investing in a bank is its reputation. The reputation of if you're a financial service company, and most of all bank, your reputation is everything. When your reputation is ruined, even from a stupid thing, people are not going to borrow from you or bank with you for years. And that's going to cost you heavy losses because you're going to have to incur expenses. You're not going to have enough demands from your deposits. It's not going to be a good thing for a bank to deal with. And that's what's going to happen with Citizens Bank. But you could have avoided this. If you invested in Citizens Bank, well, this is a lesson learned. There's nothing more out of it. It's just what happened. But you could have avoided this if you read the SEC filings. That's how you should avoid a sketchy bank. Also, let me show you how leveraged a bank is. The way how you can find how leveraged this bank is, even though this is just a general way, there's still, other additional ways specifically, but this is a wide general good way how you can see how leveraged the bank is simply seeing how much money is the bank leveraging out from people's deposits. And this is how you do it. You go to the balance sheet, you go to the liabilities and shareholders equity, if in the case for Wall Street Journal. If you're looking at maybe Market Watch or something like that, it's just in the liability section. So what you do is look at this. You grab the total liabilities. So over here, this slot is 2022. So Citizens Bank has about $203 billion of total liabilities. So what we're gonna do is we're gonna go 203.43 billion and divide that by their total equity, which is 23,690. Okay, what this is basically telling me is that the bank is practically lending out 85% of your money. This bank. So if you put in $100, this bank is basically loaning out or investing about 85% of that. They're basically taking out $85. So if you put in $100,000 into your checkings or savings account, they're literally going to take $85,000 and they're going to circulate that money. Let me show you in comparison with Microsoft, and then go to the liability section. Watch this. The total liabilities of Microsoft is about 205 billion, same as that bank, and Microsoft is one of the biggest companies in the world. That's how leveraged a bank is. Like, seriously, look, Microsoft I think is like the top 5. I think it's, if I'm not wrong, I think it's the 3rd biggest company or the 4th biggest company, Microsoft, and their total liabilities is the same as this small regional bank. That just shows you how leveraged banks are. Okay, now divide that by the total equity. I mean, you can just see that it's almost the same. Divide that by the total equity 206. In fact, Microsoft doesn't even lend, right? This basically means that Microsoft is almost not even leveraged. Like, look, they have the same equity as their total liabilities. Okay, let's grab another company as an example. Let's say we grab Metaverse. If we grab the total liabilities of Meta, it's about 60,014, and then divide that by the equity. Watch, the equity is just more. Yeah, the equity is actually just more. Let's grab Apple. I'm trying to find like a company that, so I can show you the difference. Yeah, you see? But it's not as leveraged compared to a bank. So Apple's total liabilities is $290 billion. And then total equity is 62,146. Okay, so they were basically leveraged by 4.6 times. So let me tell you this. A bank, a big bank, not every bank. A big bank is usually going to have a 1-to-9 ratio. A normal company, whether it's technology, whether it's in consumer staples, whatever, or communication services, sometimes they're going to have a ratio from 1-to-1, or sometimes 1-to-0.5, or other times they might have like this 1-to-4. But a bank is usually going to have 1-to-9, right? So that's the thing about a bank. Now, does that mean banks are bad investments? No, that it doesn't mean like that. It just simply means that you don't want to invest in every bank, because think about it. If you don't invest in a good bank, it's very risky, because a bank is utilizing other people's money a lot. And that's how they're making money, by literally using everyone's money and then investing that. And so if they don't invest that in a conservative growth way, and they're so focused about growth, like what's happening lately with a lot of investment bankers, which is a very bad problem, where they're putting a lot of money into cryptocurrency, because cryptocurrency is a cyclical thing, right? It's a fluctuating market price. It's stupid to lend out all your depositors' money into this asset when it fluctuates. And if you're a business, you're operating expenses. And so it just doesn't make sense. Those people are gonna lose money. And so that's the thing about a bank. And by this nature, that's why if you look at, let's look at even Bank of America, right? That's for now sketchy banks. So you guys know how to avoid sketchy banks. Now, how do we find a good bank? It's simple. It's kind of a general rule of what I have. First of all, the most important thing to look at a good bank is that they have a great reputation. You do not want to invest in a bank that has a bad reputation. For example, you wouldn't have invested in Credit Suisse, because Credit Suisse has had a terrible reputation, because Credit Suisse for the past 10 years has been involved in mafia, has been involved in scandals, has been involved in fraud, has been involved in spying in their own employees. I mean, they're a complete thug company. They've been even involved in cocaine in the mafia. It doesn't make sense. That's why for me in investing, it's like getting married. If you marry someone and they're involved in all these sorts of things, then you should definitely be expecting those sort of results for yourself. You should be expecting bad results. But if you decide to marry someone who's responsible and caring for what they do, then you should expect those results. It's that simple with investing. And it's very important with financial companies like banks. They have to have a great reputation. Bank of America has a good reputation. It doesn't have a marvelous reputation, right? Because I don't think that's common even for banks, but it has a good reputation. It doesn't have a bad reputation. So that's a good sign. And if you look at Bank of America is a very stable bank. Now, there's of course other measures that you need to look at, but this is one of the general big measures in looking at what they're investing in. So, because that's how a bank makes money. If you look at their total assets, so let's look at their. I want to compare to you the liabilities and the total equity. Their total liabilities is about 2778, so it's about $2.7 trillion that they have in total liabilities, which is normal for a bank this size. And then their total equity is about $273 billion. So that means that Bank of America is basically leveraged by 1 to 10. which is normal. That's not a bad sign. That's actually normal for the size of this bank. This Bank of America is one of the top 3 biggest banks in the world. The biggest bank in the world, I think, is JP Morgan right now. I think Bank of America is like the second or third. I think it's the second. Now, if you look at their investments is about $1.6 trillion. So they have more investments than what they have in loans. But that's not a bad sign because we need to look at the total assets, right? Because it's based upon percentages. So their total investments is about 1.6690,063. Grab that by the total assets, which is $3 trillion. 375. Okay, so Bank of America has a bit more assets, right? I'm not gonna lie. Bank of America does have a bit more investments in securities than they should. So that's not a fantastic thing. But it's not incredibly huge. Now let's look at the loans. The loans is about 1033,065. Let's grab that by the total assets. 3051, 375. Okay, so their net loans comprise about 33% of their total assets. I'm not gonna lie, that's not fantastic. These measures are just simply seeing how stable the bank is. Now I'm gonna show you something. If we go to Google Focus and we look up Bank of America is making money by many ways. But the biggest way how it's making money, which is a good thing, is consumer banking. Consumer banking combined with global banking is already taking about 63% of their revenue. And that's just in banking. And I like that. It's on in comparison with like Citigroup. I'm going to show you with Citigroup. Citigroup has more than 50% of the revenue comprised on institutional clients groups. So I looked at the filings, and that group's majority of revenue is actually coming from their investments. Citigroup makes a lot of its money. They make money, of course, from banking, but they make majority of its money from its marketable gains, from bonds and treasuries, that sort of thing, and with loans. But they mostly do it with securities. In comparison with Bank of America, Bank of America's case is making a lot of its money from actually banking. And that's why, even though this isn't a fantastic thing that I'm seeing the statements, but I'm seeing that what's comprising a lot of their inflows is actually coming from the banking, which I like better. But I'm not going to lie, this could be a better case for Bank of America. Let's look at JP Morgan's case, right? So Bank of America is not a bad bank. So if you look at JP Morgan's leverage ratio is about, so their total liabilities is about 3373, and then get that by the total equity. Okay, so they're very leveraged. It's about 11 times. That's normal again. So if you look at their investments is about 2120. Yeah, there we go. So it's about $2.1 trillion. And then that comprises about 57%. Okay, that's actually more than Bank of America. And JP Morgan has a good reputation. But let's see, what's mostly comprising JP Morgan's securities? Okay, they're federal funds. Okay, so it's practically bonds. So they have quite a bit of a bond portfolio because it makes up about 57% of their assets. What about their loans? So another way that I actually look at better to look at the loans to see how much it comprises in the company is actually by comparing the loans to their deposits. So in order to do that, you just grab 11.1. Yeah, I forgot to mention that. You just grab the net loans and then divide it by the total deposits, which is right here. Total deposits, 2340,179. Okay, so JP Morgan has about 47% into loans. Okay, I would have rather have JP Morgan to have really more of their securities a bit less compared to their loans. But it's not a bad thing. I don't think it's a terrible thing. I still think that these companies are still stable and they're still ready enough to grow. Let's grab, Yeah, those are really like the two biggest banks. If you grab Wells Fargo just has a lot of loans in comparison. They have a lot of more in real estate, but that's how you find a stable bank. These are banks that you should find to invest in. Remember, it's about reputation. It's about what they're investing in. And of course, you have to do more due diligence. You have to read the company, whether it's actually more dominant compared to another bank, if they're in the same type of way of banking, right? Because JP Morgan is different from Bank of America. JP Morgan makes a lot more money based upon like prestige customers, right? Because Bank of America's customers are different from JP Morgan's. They're more sort of middle class, lower class people. It's more like a retail bank. JP Morgan makes a lot of money from actually commercial banking. They make a lot of money from corporations and banking with them, which makes sense. And also it's commercial and it's also consumer, but it's most of all commercial and investments. And JP Morgan is literally the top dominant when it comes to prestige commercial banking. There's no bank in the world that is up to their status when it comes to commercial banking. There's no one. They're literally the go-to bank. They're really good at that. Bank of America is the most popular when it comes to consumer banking. And it makes sense because I think they just have a wide variety to people. And I think even though it's not fantastic, but they have a well-structured way to operate because they get to attract different varieties of customers. They get to attract middle class, which has a bit more money, but they also get to attract people who don't have a lot of money compared to middle class. And so you get a wide variety of people in comparison with JP Morgan, Chase. You don't really have people who are lower than middle class. You either have upper middle class with people who have high net worths, which is now the commercial banking. So you might be saying, okay, so we know how to find stable banks and we know that JP Morgan and Bank of America are stable. Yet why are they dropping? Right? Why is Bank of America dropping? Why is Citigroup dropping? And why is US Bancorp dropping? Because of macroeconomics, not because of what the bank is doing, and also because of what's going around in the banking industry. A lot of investment bankers are saying that there's going to be a big problem in the future, but that's because of these smaller banks like Citizen Bank, what happened with Signature Bank, what happened with Silicon Valley Bank, what happened with First Republic Bank. A lot of these banks are so focused on growth, and that is going to slightly affect with the banking industry. But I don't believe that that's going to affect heavily with big banks such as Bank of America, such as JP Morgan. It's not, because Bank of America is not reliant on one area specifically. Bank of America has many ways to earn money. They're not focused so heavily on growth where you don't see so much money into bonds or any of these sort of things, or so much money into real estate, into mortgage-backed securities like in First Republic Bank. You don't see that. Neither do you see that in JP Morgan. And that's why if you look at the share price right now, right? If we look at Bank of America has been dropping like Citizens Bank, but it's not for the same reasons. It's just because of high interest rates. And you need to recall, when there's high interest rates, there's a fear that they're not going to make as much money with the loans as much as anymore. And that could be true to some point, but you need to remember that Bank of America makes money by consumer banking, not just by the loans as of itself. In fact, you saw that majority of all their assets are coming actually from the securities, from bonds and such, or mortgage-backed securities. And so that's why I said, like, this isn't a terrible thing that they have so much in the 50%, because I can also understand why of what's happening with the loan section because of high interest rates. So that's why you need to have a perspective. You need to understand the reasons of why they're doing things, and it's not a bad reason. In comparison with JP Morgan hasn't been going down, and I would say that's just the way how they're structuring. Bank of America is mostly because of what I would say, what could be for many reasons, to be honest. But that's why these bigger banks are coming down. It's not because of what they're doing in their banking. It's because of other banks, and it's because of macroeconomically. So, should we sell these big banks? No, you shouldn't. You should not sell these big banks. I don't know if you looked at Warren Buffett has actually sold a lot of financial companies. The biggest reason why Warren Buffett, which is the best, he's like the best investor when it comes to banks, is because he invested in some banks in where they were greedy. That's what he said. He just exited out of their position, not because they were bad banks, but because the people who were operating the banks were focused too much on growth. And I'm not going to lie, that is happening frequently. But that's not the case for Bank of America. Neither is that the case for JP Morgan. Okay? So that's why there's pessimism on the banking industry. And to be honest, if I were you, I'd be taking advantage of that. Because if you're holding a valuable bank and there's pessimism over valuable assets, that asset price is going to go down temporarily, which is going to give you a cheaper price to buy. And as things settle down a bit, which they will eventually, you get to buy a bank at a very cheap price, or a financial company. And when you know that the intrinsic value of that company is higher, then you get to appreciate on that investment. So what I'm going to do, I'm going to give you guys a bit of a present today. I'm going to grab the intrinsic value of Bank of America, so you guys can know whether it's again, this isn't, I'm not a financial advisor or anything. This is just based the way how I analyze, but I'm going to give you guys the intrinsic value of Bank of America. Now, the way how I grab the intrinsic value of Bank of America in comparison with Apple is a bit different. Usually, I tend to grab a discounted valuation based upon what it will do in the future, which I'm going to do the same in Bank of America, but I'm going to do it slightly differently. Also, I forgot to mention, why is Goldman Sachs and why is Morgan Stanley being sideways? Because of what's happening with the banking industry. And macroeconomically, a lot of people just fear of their financing section in their investment categories are not going to grow exponentially in the few years. And so insiders, hedge funds are shorting in these type of companies. And also for management reasons, you do have to do your due diligence in Morgan Stanley and Goldman Sachs to check very deeply if these companies are being stable and they're investing in a responsible way. Because these companies, even though they're not solely on banking, they're more solely on investing, they do use leverage. They use people's funds. So it's sort of this, it's like the same situation. You need to see that the people operating these firms and these companies are looking for long-term growth, not for quick growth. You want these companies to avoid risk. You want them to have stable growth. Well, let's get down to Bank of America's intrinsic value. Okay, so here's what I do. So the way how I find the intrinsic value for a bank is by grabbing the price to book value. It's by grabbing the price to book ratio. So in Thinkorswim, we have a indicator plotted from Selection. In Selection, we have a price to book ratio that you can find the valuation for banks. So right now, the current price to book value of Bank of America is about 0.80. Now, the way how I know that is because if you know the price to book value, or the price to book, it's simply by grabbing you grab the shareholders equity, which is right here, right? It's this one. It's this number right here, total shareholders equity. So we grab $273 billion, 197. So each number is about $1 million. Okay. Now what we do is I want to grab the total shares outstanding of Bank of America. So it's about 2.91 billion. So that means each number is about $1 billion. Okay, so if it's 7 billion, then it would be about 7,000 million, right? Because 1,000 is a billion for 1 million. So what we do is we grab 7,910, right? Because it's about 7.9 billion. Okay, there you go. This is the book value of Bank of America. However, to get to price to book ratio, what you do is you just grab the current price, 27.64, and divide it by the book to value. There you go. You see, the price to book ratio is about 0.80. If we look at Thinkorswim, what I like to look at is the way how I find the intrinsic value for a bank is by looking at what was the average price to book ratio for the past 10 years. So this is grabbing for the past 10 years. For the past 10 years, it's been about 1.03. Right now, it's about 0.80. So that means that it's undervalued. It is undervalued. How much is it undervalued? Well, the way how I see it is it's about 0.80. However, how much does it take from 80 to get to 100? Right? Because 100 to 80 is about a 20% drop down. But how much would it take from 80 to get back to 100? Well, it would be about 100 divided by 80. Okay, 25%. Okay, what's the current price to book value right now? It's about 34.53. Yeah, because that's the valuation. The current share price, because that's what we're grabbing, the current share price right now is about 27.63. What we grab is we grab 1.25%. There you go. This is the intrinsic value of Bank of America. How much undervalued is it at? So the current price of Bank of America is 27.63 and the intrinsic value is 34.53. So it's all the way over here. 34.53. There we go. This is Bank of America's intrinsic value. So right now, Bank of America is about 20% undervalued. So this could be a time to buy. Yeah, this could be a time to buy because you're basically buying this bank 20% undervalued. That means you're pretty much, it's not that you're guaranteed, but you're very highly likely to make about 25% of your money if it gets just back to valuation. So that's how you find banks in this video. I think it was cool reviewing this because there's so much fear in the banking industry, and I can understand why for many of these banks falling down. But it's simple. If you find a great bank, the thing about banks is that they're cyclical. They're cyclical. So that's why in comparison with Apple, I usually tend to grab 20 years to 30 years, and I don't tend to grab an average like banks. I tend to do a discounted valuation formula. But for banks, this is the way how I do it. Because the thing about banks, so I could show you, is that when I look at Apple, I always try to find if it's making consistent revenue or consistent net income for the past 5 years or the past 4 years. But for banks, I don't do the past 5 years. I do the past 10 years. If I look at Bank of America, look at Bank of America's net income. Let me show you its net income. Bank of America's net income for the past 5 years has been like up, but it's been up and down. In comparison with Apple per se, look, Apple's net income over the past 5 years has been going up. You see? So that's why for banks, I tend to be more conservative and I don't look at the past 5 years. I look for the past 10 years. That means that here's the deal. If you're going to hold banks, you don't like any company. I don't invest in companies to hold them in the next 5 years, anything. Any investment I do in the stock market is the objective to hold them for 10 to 20 years or more than that. For banks, I usually tend to want to hold them more than 10 years. I generally at least want to see that this bank can consistently make over the next 5 to 10 years, can consistently grow their net income, their cash flows for the next 20 years. And so the way how I do that is to see if it's been consistent over the past 10 years. And it has. Look at its net income. It's been going up overall. That's why I don't buy banks at fair price, because banks are slow. Banks are slow entities. They don't grow exponentially. Why? Because they're conservative. They leverage too much. You don't want to have a bank to be high growth. And that's why banks, a lot of small banks right now are so focused on growth so they can attract investors, which is stupid. It's like very stupid. You should not be doing that. You want to be stable. That's the point about a bank. That's why Bank of America and JP Morgan has lasted so long, because they didn't do any of that stupid stuff. They didn't do anything like Lehman Brothers back in 2008. They didn't do stuff like Washington Mutual Bank. They didn't do things like Citizen Banks. They're not like that. They're conservative. They're stable. That's why I invest into them. And that's why I know they will last a long time. That's what you should look into bank. That's it for this video. Hope you guys enjoyed it. And we usually upload this type of content on the channel. Things about the economy, things about the market, things about companies, things about the current economic events in the stock market, and whether you should take advantage of them. Okay, so that's it for now. I'll see you guys in the next video. See ya. And beat the hell out of inflation.